In early 2026, the national average market price for live pigs completely collapsed to 10.29 RMB per kilogram. For the agricultural sector, this figure represents a total erosion of the industry-wide cost floor of 12 RMB. Even the most automated industrial farms cannot break even at these levels. At this price point, every single pig sent to slaughter burns cash. The entire industry is trapped in a systemic, unavoidable bleed, hemorrhaging capital with every passing day. This document is the Q1 2026 earnings report for the industry's largest player, Muyuan Foods. Look at the net profit line. Over a single quarter, the company posted a net loss of 1.21 billion RMB. Yet institutional capital is reacting with surprising resilience. This is a recent China Post Securities research report. Despite the billion RMB hemorrhage, analysts are maintaining their buy ratings. To understand why smart money is holding the line, we are conducting an institutional-grade stress test on this stock. We will pit the red team bull thesis against the blue team bear thesis to determine if Muyuan is a ticking debt bomb or the safest alpha asset in the sector. Evaluating a massive agricultural firm at the bottom of a commodity cycle requires a shift in perspective. When an entire industry is losing money, the analysis moves from standard revenue multiples to absolute mathematical endurance. This is a sine wave chart plotting historical pig prices. It maps the swine cycle, a predictable 3 to 4 year loop. It is driven by a biological reality. It takes about 10 months from breeding a sow to slaughtering a piglet, creating a lag between supply gluts and market shortages. Looking at the current timeline, the cycle hit a peak of 20 RMB per kilogram in August 2024, but the resultant supply glut eventually pushed prices off a cliff. By late 2025, the market crashed deeply into the red loss zone below the 12 RMB line. The logic of this trough is brutal. The market requires sustained, excruciating pain to force inefficient producers into bankruptcy. Only mass herd liquidation can reduce supply enough to clear the market. For institutional investors, this deep trough is a waiting game. In this phase, capital is betting on a simple equation. Survival during the trough ensures maximum exposure to the next period of high margins. The red team bull thesis rests on Muyuan's vertical integration, the self-breeding, self-raising model. Unlike competitors who outsource to independent farmers, Muyuan maintains absolute control over every production element. This closed-loop system acts as a fortress. By keeping all raising in-house under strict protocols, as seen with these workers disinfecting the facilities, Muyuan cuts off pathogen transmission routes, lowering mortality rates even during African swine fever outbreaks. High survival rates provide the necessary volume to scale the industry's most critical efficiency metric, PSY, or the number of pigs weaned per sow per year. This equation illustrates how breeding efficiency dictates costs. The change in complete cost per kilogram is a direct function of the increase in PSY. As the PSY metric moves from 27 to 30, fixed costs like land and equipment depreciation are diluted across a larger volume of piglets. This single biological improvement drops unit costs by 0.15 RMB per kilogram. This chart maps Muyuan's Q1 2026 cost profile against the industry. While the national average hovers above 12 RMB per kilogram, Muyuan has driven their complete cost down to 11.6 RMB. They are still losing money at the current 10.29 RMB market price, but at a significantly slower rate than their competitors. They compound this advantage with specialized nutrition profiles, specifically low soy diets that reduce their reliance on expensive imported raw materials. Furthermore, their downstream slaughtering business provides a cash hedge. In Q1 2026, their slaughter facilities operated at over 100% capacity, turning a profit of nearly 20 RMB per head. The red team argues that Muyuan has physically engineered a structural cost floor. They are mathematically positioned to outlast the competition in a war of attrition. The blue team bear thesis counters this with a financial reality. An operational moat provides zero protection if the balance sheet collapses before the market recovers.
Vertical integration carries a heavy asset curse. Building these massive industrial farms required immense capital. Even if management scales back production, empty barns still incur fixed depreciation costs that drain cash reserves. This maturity wall block chart visualizes the duration mismatch on Muyuan's balance sheet. Look at the liquidity ratio. The company faces roughly 46.6 billion RMB in short-term borrowing and liabilities. This red block towers over their green cash buffer, which sits at just 14.27 billion RMB. What makes this maturity wall dangerous is an underlying macro threat known as the productivity paradox. Traditional market indicators suggest the cycle should be turning. National sow inventories have dropped to roughly 39 million heads, which typically signals an impending supply reduction. This graph shows the paradox in action. The line for sow headcount is dropping. However, because firms like Muyuan pushed sow efficiency from 18 to over 28 piglets per sow, the second line, total pork tonnage, stays flat or rises, we have fewer sows producing more meat. This efficiency gain artificially extends the duration of the cycle bottom. It prevents the sharp price rebound that usually follows mass liquidations. For the blue team, this makes Muyuan a liquidity trap. If the cycle bottom drags on for another 18 months due to overproduction, their 14 billion in cash could evaporate against their short-term obligations long before pork prices recover. Muyuan's management is aware of this liquidity timeline. In response, they have shifted their corporate strategy from hyper-expansion to defensive deleveraging. They slowed their capital expenditure significantly. After peaking at 46 billion RMB in 2020 to build their farming empire, projected spending was slashed to just 9 billion for 2025. Simultaneously, they executed a strategic offshore capital play. By successfully pursuing an H-share public listing in Hong Kong, they opened a pipeline to inject fresh international liquidity into their balance sheet. This line graph tracks the impact of that capital injection and cost-cutting strategy. The company's asset-liability ratio, which hovered above 62% in 2023, has been forced down a steady slope. By the end of Q1 2026, the debt ratio officially dropped to 50.73%. This returns the company to its lowest leverage level since the explosive growth of the African swine fever era. This stability is confirmed by institutional evaluators. The company maintains an AA+ credit rating from China Chengxin International, securing their ability to roll over existing debt. While the debt structure remains weighted toward the short term, management slashed the overall scale of total liabilities by over 3.1 billion RMB in the first quarter alone. By neutralizing the immediate risk of a debt default, management has bought the company time, shifting the focus back to their operational cost advantage. The investment committee debate boils down to one question. With the debt structure stabilized, can Muyuan survive the trough long enough to capture the next upswing? To answer that, analysts look to the Muyuan Law's law. This timeline highlights 2014, 2018, and 2023, periods where the company posted a quarterly net loss. Because they're the lowest cost producer, these red markers historically precede massive rebounds in stock valuation and hog prices. Looking at the forward 2027 estimates in this valuation table, we can establish the current margin of safety. Analysts project a price-to-earnings ratio of 6.93 and a price-to-book of 2.39. A forward PE ratio under 7 suggests that the market has already priced in the blue team's downside warnings. The risk is built into the current valuation. The catalysts for recovery are already in motion. The supply shock from early 2026 sow liquidations will inevitably intersect with a seasonal surge in Q4 pork demand. When that intersection occurs, Muyuan's massive scale acts as a tightly compressed spring. A single RMB price increase instantly adds billions to their bottom line. Muyuan functions as an asymmetrical call option on the swine cycle. Management has stabilized the debt. Now, their valuation is driven entirely by their structural ability to print cash the moment hog prices cross 13 RMB.